Hello, everyone. This is Ron James here at Opscale Exchange, and I'm here today with Sunil Cherion. And we're talking about tax strategy and how tax strategy can benefit and who it can benefit and why it's important for small business owners and individuals to really make sure that they're planning out their tax strategy. So it's great to have you here today, Sunil. If you will tell us a little bit about you and a little bit about how you got into this tax strategy work.
Thank you, Ron. Thank you for the invitation. Good to meet all of you. My background is actually I started off as an engineer turned entrepreneur in Silicon Valley, and I have had multiple small businesses myself. And one of the things that I realized was that business owners have a lot of advantages that people on W-2s don't have. Okay, so when you're a highly paid professional, a lot of the times you really don't have any tax advantages, whereas business owner pays taxes on net income, and W-2 pays taxes before you see it. Right? That's a big difference. And my wife got into financial planning and tax planning about 10 years ago. What got her interested was that one of my classmates had passed away, and we had to do a GoFundMe, and his wife and daughter had to go back to their home country, which was kind of traumatic for the rest of us. So as she talked to other friends of hers, she realized that most women did not really have that financial understanding because many of them left that thing to their husbands. Right? So she got into financial education, and as she got into it, I started learning a lot of advantages about deferring taxes, keeping money in Roth versus 401k. So that got me interested, and over time, when a lot of our clients were asking for help with taxes today, what you can do with income today, that's really what motivated us to get into it.
Okay, perfect. So tell me a little bit about what makes tax strategy different than tax preparation. You know, most of Americans just do tax prep and file that in April, or do an extension and file it in October. What makes tax strategy different than that?
Planning is a very different activity than filing. Filing is more around, let us report on what you did last year. It's a compliance activity, and you come on April 15 and you are reporting on things that happened in 2025 or 2026. It's too late to actually start planning because the year is over. Whereas planning is thinking ahead. What should I do? What kind of structuring can I have? Because if you understand the laws are written to incentivize people to create jobs. So that's why business owners get an advantage. They're incentivized to help people create housing. That's why people who own rental properties get an advantage. So if you understand how the laws are written, it's your choice whether you want to do those activities that are designed to help the country, and therefore you can take advantage of some of this tax planning. So sometimes it takes investment, but you have to have the money and you have to plan to have the money to do that. But if you combine them together, it's a fantastic way to build wealth.
All right, that makes sense. So some of this requires investments on your part and really hiring somebody to help you do this tax strategy work that really understands it. What are some of the most commonly missed things that you see that you apply that can help somebody that's just listening and is wondering, hey, what could I do today that might be able to help me do this?
A lot of people start some kind of home-based business, and they get it to a level where they're making a decent income out of it. And they realize that, hey, if I had an entity structured, perhaps that entity could have given me a little bit more write-offs that I could have. Like an S-Corp structure, for example, it gives you a little bit more write-off than not having a structure or an LLC structure, right? So there's some things you can do by properly structuring it. Things that you're able to monetize, for example, let's say you're using an office in your house and it's dedicated to the business, you could actually pro-rata rent out that space to your business if you want to monetize the use, because if you had to go elsewhere, you would have had to pay rent for it anyway, right? So that's a home office reduction. there could be similar use of vehicle. If you're using your vehicle 50% or more for business purposes, and if you're able to document that you're using it for business purposes, either by mileage tracking or by keeping calendar events that you're keeping accountability, then you are able to document and get the write-off. Okay? So a lot of this is really around proper documentation. It's not mixing your personal stuff with your business. Keep your business activity separate from your business activity. So you keep your accounting clean, you get your data in place. And you could be hiring some family members to work for your business. As long as they're able to do legitimate activity, you're able to pay them. Now that they have earned income, they're able to put the money into a Roth IRA that they would qualify now that they have earned income. So it's stacking these things that actually allows you to save some significant money.
Yeah, that makes sense. A lot of people don't understand how to stack it, and they don't keep proper documentation.
Yes.
So working with someone, and I think that's where the strategy part comes in, is making sure that you plan and keep that documentation and are prepared for it. That way, that it's clearly documented. What who benefits the most from a proactive tax strategy, and who is not a fit?
So, since some of the strategies require investment, the investment is for accredited investors. By definition, if you are a single person who's made $200,000 or higher in the last 2 years, or married filing jointly with $300,000 or higher income in the last 2 years, or you have $1 million net worth outside of your primary home, then you are an accredited investor. That literally opens up a ton of opportunities for you. And a lot of double income families are in that bracket, but they don't realize that they have that. So one example is, if you buy a rental property, you are eligible to depreciate the property. Normally, CP is depreciated over 27.5 years. And if your income is higher than 100 and just a little bit over 150K, you don't really get the benefit out of it in terms of the depreciation, carrying and reducing your income. However, if you are able to actively manage that property, one of you, at least husband or the wife, and they are able to spend 750 hours or more documented, that you have clear activities that you're managing the properties. And if it is more than what you do in a full-time job, then you can have your active income decreased by the active depreciation that comes from the property. But in order to be able to have a meaningful impact, you will need to probably do a cost segregation study, and that's done by an engineering firm who can tell you that the carpets need to be replaced in 5 years, or your cabinetry needs to be replaced in 15 years. Depreciation is really an allowance for replacement in the future. So you're just bringing it in so you can reduce your active income with activities. But if both of you are working 40 hours a week, you may not be able to do that. But you may be able to do the same effective thing with 100 hours if you do short-term rentals.
So if you're a W-2 employee, can you still take advantage of some of these?
Absolutely. So the main thing is you can only have an active loss that can offset from an active income. So W-2 is active income. You cannot take a stock market loss, which is passive in nature. You can only do about minus $3,000 a year. But if you can qualify to do 100 hours of management for an Airbnb, for example, then that is treated as active, and you have to spend more time on it than anybody else who's working in the business. So this is about real work. You're doing real active work, and it's business. A business activity that generates a loss because you're pulling in the depreciation into year one, which normally would have spread out over 27.5 or 39 years. Now you can offset your active income with that.
Okay, that makes a lot of sense. So what does the process actually look like? If I'm a business owner or client that's wanting to go through this process, what does it look like for you to do this process?
So normally it starts off with a free consult. So we sit down with them for about 30 minutes or so, and we need to understand their situation and where they are, what are they planning to do, what did they do in the last 2 or 3 years. And normally then after that what we do is we it's a paid activity. We spend a lot of time working with them in understanding this. So we tell them upfront, hey, I need to now take a look at your last 2-3 years of tax return and to understand the patterns. Have you been optimizing it? What mistakes might have crept in that you didn't know, right? Let's analyze that. Once we analyze and see that there are potentially things that you could do this year or next year, we say, okay, let's talk about some of the possibilities of what you can do. Okay, and if you're able to execute those activities that qualify you, then we can say, okay, here is the plan that we can implement for you. So this entire process takes 5 to 10 hours of work on our side to create this assessment. And you can take the plan, you can go and implement it yourself, and it's a do-it-yourself kind of plan, right? People who need help and people who need one of our experts to help them with it, then we have a do-it-with-you plan. So we can say, okay, you need help with tax filing, you need help with audit protection, and then it becomes a lot more activity on our team side. So that's more of an annual kind of work.
Okay. Can my CPA do this for me?
Absolutely. I believe they should. But unfortunately, what happens is many of them are heavily overloaded during the tax season, and hits them in March, hits them in April, hits them in September, in October. So depending on whether heavy on business clients or whether they're dealing with late filers, so their workload shifts. So a lot of the time, when you go into the CPA's office, they really don't have time for you because they're trying to get hundreds of returns done by April 15. So ideally, they should be sitting down with you on a quarterly basis, certainly before end of the year, to look at your plan. And sometimes planning ahead means that you're looking into your retirement planning, for example, or you're looking into college planning, because how much income you take during retirement is currently dictated by IRS. Because if you don't plan ahead, you're going to pay required minimum distributions that force a certain money out of your 401k. So a lot of people are good savers. They built up substantial money in the 401k. But they did not know that they had made a deal where not paying a few $1,000s in taxes today is going to create a major problem of hundreds of thousands or millions of dollars in taxes later. They don't know.
I think that's why my financial planner always encourages me to do the Roth 401k so that I'm paying the taxes today versus deferring those taxes down the road.
Yeah. And my wife, uses an analogy, which is, let's say I were to give you 100 apple seeds. Okay. And I'm going to say, hey, Ron, you can go plant it, grow the orchard, whatever you produce, there's no taxes, anything today. But when you produce it, I'll take a share of it. It might be 20% today, might be 25%. I'll determine how much it should take from you. And when you get that thing working and it's got thousands of apples coming every year, I might say, hey, I want 50% because I set the rules. I'm that partner, right? Alternately, you can say, you know what, that 100 is really not 100. You pay 30% today, and the 70, you can do whatever you want. What's your choice?
It makes sense. Yeah. As I think through that and how it works, I have a lot of friends that I talk to, and they don't take advantage of these tax strategies. They're high net worth individuals, people that are very intelligent that have never done it. What is the biggest misconception that you see from owners about tax strategy and why they don't do it?
A lot of it is lack of understanding and misconceptions. So, for example, Roth conversion, people might understand that they should do it, or Roth 401k, they should do it, but I'm not getting the tax write-off of that today, right? So they're thinking that, I should be getting the write-off because they're conditioned to contributing to 401k, etc., right? So that's one mindset issue. They have to understand that $5,000 or $6,000 you saved on the 401k today, what if you had some tax strategies available to you that would have given you that $5,000, $6,000 anyway? So if that was essentially neutral to you, Would you rather have the money go into 401k or Roth 401k? Right?
Yep.
So by planning ahead, that is one thing, right? The other conception, you know what? We are all supposed to pay taxes. Absolutely. We need to pay taxes for us to have roads and military and all the stuff we need to have taxes. But do you want somebody else dictating how much should be based on their whims and fancies or needs in the future? Or do you want to be able to control how much that should be?
Nice. That's a really good example, and just being able to be in control of your own destiny there versus, hey, it's set out. Here's the tax bracket. Here's where I fall, and this is what it is. I think a lot of people have this misconception that as long as they're taking their normal standard deductions and those types of things, that they're paying as least as they can, and they feel that way. And I think that's a misconception from a lot of CPAs that are missing some of these other strategies, because it takes a whole team to implement these strategies. That the CPA has to be involved, but it's got to take a whole team to get these. How do you make sure that everything you do is done right and ready for an audit if the client was to be audited?
The team is really the answer. Okay, so what happens is there are other misconceptions like, oh, this guy must be cheating, or this is illegal, or they're doing something that is only open to the rich people like Elon Musk or Donald Trump or somebody like that. They must be doing something not so right? Now, one of my friends, CPA, who mentioned that his ex-boss, who's one of the richest guys in America, they had an entire floor at the company devoted to tax strategy work. Right? So he had CPAs and he had estate planning attorneys and he had all kinds of experts available to him. And the rich people are able to afford it. So they have the know-how that helps them. Now, what we are able to do is to build a fractional family office kind of service for people who are not quite able to hire these people full time. We are able to bring CPAs, estate planning attorneys, we are investment managers, we are bringing insurance agents, we are bringing a whole team together so that when we bring that expertise, we can look at every activity and say, is this a black or white? Or are you doing some hokey deductions? But when you have an opportunity to do things right, why do you need to walk into the gray area?
Yeah, no, that makes total sense. I mean, the tax laws and tax theories are out there that provide this. It's just finding them and finding the right people. And to your point, really being able to make it affordable to the everyday small business owner that doesn't have the resources that Trump and Bezos and Elon Musk have. And so I think that's a great piece of this. Well, is there anything else that you would want our audience to know today about tax strategy work?
I think the one question you asked earlier about CPAs, right? The CPA's mindset is episodic, meaning I have a transaction to finish today and you are one of 500 or 1,000 transactions I need to finish by this deadline. So even if they wanted to help you, they just don't have the mental bandwidth to sit down and figure this thing out. Some of the strategies involve looking few years ahead. For example, what you do when you are 61 is critically important, because if you wait till 63, your Medicare premiums are going to be affected with the IRMA penalties based on how much you were drawing when you were 63. When you want to retire, whether you should take Social Security at 62 or 67 or 70 depends on whether you're going to be taking money out of your 401k or somewhere else, or whether RMD kicks in for you at 72 or 75. So there are critical age periods that some of these things matter. So planning is really a longer horizon. So you do need a financial planner who understands tax planning to be able to really optimize for the long run, not just how much should I pay today.
Perfect. Well, thanks for joining me today, Sunil. And if any of our audience wants to get more information, there's a lot of information out there at opscalepartners.com on tax strategy, and we're happy to help you and connect you with Sunil's team to get this work done. So thank you again, Sunil.
Thank you, Ron. Appreciate the opportunity here, and nice meeting all of you. Thank you.
Thank you.